Crypto is changing people's lives, and Ethereum could be one of those coins to do that for you. So I'm sure you're wondering, how many coins should you be stacking up right now? I'm Brett at CryptoGX, and in this video, we'll keep things simple. We'll check real data on where Ethereum might land in 2025. We'll see why it's called the fuel of the biggest smart contract network. We'll run quick math to find your own Ethereum goal, weigh risks like price swings and US rules, and end with really one clear number that most beginners can aim for. Let's jump in. First, let's talk numbers. What could one Ethereum cost by the end of 2025? There's lots of predictions out there from people that are crypto experts, that are finance experts, and lots of people on YouTube like myself. So I like to get lots of different opinions and find articles like this right here, as you can see on finder.com. To simplify this article, a middle road guess for where they think that the Ethereum price might go is around $4,000. The high end that they have listed is just shy of $5,000, and on the low end, they've got about $1,500. Now, obviously that's a pretty wide range, but there's lots of different predictions out there, and we'll talk about why in a bit. Another prediction I found on Coinpedia, they have the highest at about $5,000. As you can see, if I scroll down all the way to what they think the price will be in 2025 at a maximum of $5,925. Now, these are what I would call third-party projections, but big banks are noticing too. Now, you can see on the Nasdaq website right here, this is an older article from October of 2023, but they were predicting that Ethereum could reach about $8,000 in 2026. This would line up with a $6,000 to $7,000 zone sometime during 2025. Now, backing away from the bank realm and more into the crypto realm, the CEO of Abra is actually predicting a $16,000 Ethereum price target. This is very exceptional proof of how wide these opinions can run. Now, if you think about watching the charts of Ethereum short term, there's lots of people that day trade or swing trade and are kind of eyeing the general movements of Ethereum. People that are looking at this are thinking of a breakout towards about $4,000 pretty soon. Recently, these people that were tracking the charts showed an ascending triangle formation pattern, and basically this is a signal that buyers are stacking up. But why are people stacking up? Why are these prices climbing already anyway? Well, let's take a look into that. The first aspect is a supply squeeze. Since Ethereum switched to the proof of stake model not long ago, a couple of years ago, part of every transaction fee gets burned. And burn basically just means that it is permanently destroyed. So a piece of Ethereum is completely removed forever, shrinking the supply. And obviously, if you know a little bit of macroeconomics, when supply goes down and demand remains the same, price goes up. And about 28% of all Ethereum is now locked up earning staking rewards, which is leaving fewer coins on exchanges and being available to trade, aka to sell. So those coins are not driving the price down at all. The next thing is layer 2 upgrades. And it's not too important to know exactly what this is, but essentially the Ethereum network is basically a place where developers can run decentralized applications and build upon, and that's kind of what layer 2 is. They're having major updates. One's called Denkin, and you can look a lot into that, but this is inviting millions of new users and applications, and that's driving value for Ethereum. But with these two things that could be pushing up the price, risks still really matter. If we look back at this report on finder.com, a bear market, which is a long drawn out price drop, could drag Ethereum near $1,500. This is the low end of the Finder's range of their prediction, but this is solely if there is a long bear market, which we're not seeing at the moment, and lots of people are predicting that the crypto bull market could go sometime into September or maybe even October, depending on who you ask. We are experiencing a weird environment within the kind of US political spectrum and the US economy in general, so tough new US rules, if they come up, could cool off investor appetite for buying these coins, although personally I don't see that happening with all of the kind of crypto positive policies that the new administration is actually going for. Now let's talk about demand and how that relates to the whole value of Ethereum, or market cap. Market cap is just the total value of all of the coins. When demand shifts, both the market cap and the price move together. So with all of those positives and negatives, think of the potential price movement for Ethereum in 3 different lanes. The first lane would be the bear lane. This would be if the sentiment for the crypto market as a whole, and Ethereum specifically, turns to a bear market. This range would probably be in the $1,500 to $2,500 range. Now, the next lane we're going to think about, we'll call the base lane. This is steady adoption, nothing huge changes, things keep progressing forward, but nothing huge. This range would probably be about $4,000 to $6,000. And $6,000 being on the high end is inching towards this bull case scenario because the bull case is going to be extra high. And as you can guess, the next section here is going to be the bull case, or the bull lane. This would be $6,000 plus, maybe even 5 figures, if everything everything works out. So keep these lanes in mind. There's definitely a lot of things that need to go right for the bull case to happen, but they will kind of guide the math that we do in the next sections to find your target of how much Ethereum you want to get. Okay, so time to do the math. You just saw Ethereum's possible price lanes. Now let's pick an amount that won't wreck your entire budget if things dip, but it could feel huge if Ethereum pops off. Most financial professionals start with a percentage of your portfolio, meaning how much of your total investments sits in crypto. BlackRock, many other hedge funds, and basically pretty much anybody in finance in New York that would invest in crypto or tell you to invest in crypto at all will really say 1 to 2% is a reasonable slice for digital assets within your entire portfolio, meaning the rest of your portfolio should be stocks and bonds and ETFs and regular financial structures. However, there are recent advisors that are coming out to increase that somewhere between 2 and 5%. As you can see in this article right here, this particular advisor was recommending about a 5% allocation. So let's say, for example, you have $10,000 sitting around. That's $200 to $500 in crypto as a whole. And if you want to put that all on Ethereum, but if you're putting that as your total crypto allocation, that's a little bit easier to sleep on even when the prices are going super volatile, because it's not your entire life savings that you're risking all at once. So if something goes wrong, it'll only go wrong for a small section of your portfolio. Now, next come the kind of milestone stacks. So owning 1 Ethereum already beats the global average per person. Now, you can shoot for 10 Ethereum if you want a much bigger upside over time, but there's obviously the risks that we discussed. Now, if you really want to put a lot more into this and you're okay with the risks and you're a little bit familiar with staking, take a look at this website right here. If you would like to run your own validator one day, which is something within staking, basically you would need 32 Ethereum to activate validator software. And a validator is a computer that checks and confirms Ethereum transactions. Basically, you'll take your 32 Ethereum and lock it up. Now, the upside here is that validators earn small rewards called staking income when they keep the network safe by running one of these validators. But let's keep it simple. 32 Ethereum is a lot. Let's bring it back to kind of the beginner status. How do you build up your pile of Ethereum, and what's the best way to get started? Now, you could obviously just take your $10,000, or let's say you have less. Let's say you have $100. You can take your amount and just buy all the Ethereum right now and just hold it forever. And that's fine. That's one method, but I would recommend trying dollar cost averaging. This is essentially where you buy a fixed dollar amount on a schedule. Let's say like $25 every week, no matter what the price of Ethereum is, and you are averaging the cost of Ethereum that you have over time. Now, this is a tried and true method that is actually proven over time statistically to be better off than trying to buy the dip. It smooths your cost out over time. Sure, sometimes you're going to buy high, but sometimes you're also going to buy low. The good news is that new Ethereum isn't endless. And what I mean by this is that around 28% of all Ethereum is already staked, putting into a lockbox, and it's off the market, which could make the rest of Ethereum more scarce, especially if demand grows. That'll help the price. And with what we talked about earlier about certain transaction fees getting burned and that shrinking Ethereum over time, that shrinking supply is why even small steady buys can add up fast in your portfolio and increase the price over time as the supply decreases. The bottom line, beyond the potentially confusing staking and validator stuff, choose a percentage of your entire investment portfolio that suits your risk. Aim for simple milestones when it comes to price, and use dollar cost averaging so that price swings don't scare you off when you're entering into your positions. Next, we'll see how Ethereum fits beside your stocks, your cash, and any other coins you might have. So with this, let's zoom out and fit your Ethereum stack into a full investment plan. The first thing to consider with this is diversification. This is a staple term for investment advisors in all sorts of assets in different fields. Diversification basically means spreading your cash across different assets, and this keeps one bad patch from sinking the rest of your portfolio, essentially. So you can have a portfolio of all different industries and asset types, and if one is not performing that well, you'll have others that are, to kind of even it out and bring up your entire value over time. If we look at the S&P on Investopedia.com, US stocks measured by the S&P have averaged about a 10% gain per year since 1957. And you can see that here on this chart, the gains for the S&P. Now, stocks are just one kind of asset. Homes or real estate grow much slower, roughly 5% a year over the past decade at least. Crypto Crypto obviously moves the fastest and swings the widest, so it should stay the smallest slice. And I'm saying that because of it swinging the widest. Obviously, it has the most gains, but it also has the most downside when it pulls back really, really hard. So it depends on your investment horizon. If you're going to invest for 1 year, probably not the best option because, we're in a bull run right now. The bear cycle is coming up. So if you time it wrong, it could be bad for you potentially. If you're going to invest for a long, long time, then you're going to be a lot safer. So what is this slice that I'm talking about of your entire investment portfolio? If we look at Plan Advisor for the recent advisor polls, this shows that the most common crypto call, as we discussed before, is about 2% of your entire portfolio. You can bump that up to 5% for wanting to take more risk. But inside that crypto bucket, what's the right play and which assets and coins are you supposed to put into that crypto bucket? Many people recommend that beginners use a 50-40-10 rule. 50% Bitcoin, 40% Ethereum, and 10% other coins. This is a very simple way to lean on the major coins that have been performing for many, many years while keeping a small venture slice for very volatile coins that could have lots of upside potential. Now, what's the reason for this allocation and all this talk about risk? Well, let's take a look at this 2024 FTSE Russell study. It found that Bitcoin and Ethereum correlations with risk on equities spiked after 2020. Well, what does that mean? Basically, it means that there are correlations with these assets. So when investors panic, both tech and crypto can fall hard at the same time. This is why it helps to rebalance your portfolio once or twice a year. This basically means to sell a little bit of what has increased the most and then build up what really hasn't performed that much. This basically keeps your target on budget. Let's say one of them bumps up like this, you'll sell that off, you'll put it over here, and then it will reacclimate to the specific allocation that you started with. Now, finally, keep plenty of cash just for emergencies. You definitely want to have some sort of cash account that you can enter into the market if things are going down and you want to buy at a discount, or if things are going up and you see it going up more and you need that for buying things that you need in your life. But basically, it's always good to have some level of cash. And within crypto and Ethereum, treat it kind of like a hot sauce. A right size little splash can boost the flavor with potential for long-term upside without just burning a hole in your mouth or burning a hole in your pocket. So where does that leave us? How much are we putting into Ethereum based on this upside? If we think back to the beginning, the Finder panel puts Ethereum around $4,000 in late 2025. And right now, roughly 28% of all Ethereum is already locked in staking. So the supply is down. And locked in staking, to simplify, is when holders park their coins to help run the network and they earn rewards off of them, taking them off of the market, basically, so they're not selling them. Big investment firms like BlackRock and financial advisors are going to tell you to put 1 to 2% of your entire investment portfolio into crypto at most. Some will say up to about 5%. Myself, I am a crypto maxi at the moment and I'm 100% in on crypto. But after this crypto bull run, I'm going to diversify into stocks and all sorts of assets because, it's really important to be diversified, but you got to take some risks in the beginning if you really want those gains. Within your crypto portfolio, most beginners will start with a normal 60-40 or a 60-30-10, which is basically 60% Bitcoin, 30 or 40% Ethereum, and 0 to 10% of much smaller coins. I don't recommend a whole lot of meme coins, maybe here and there if they're like the really big ones, but other altcoins that have some sort of intrinsic value and foundation of what they're trying to build under it. Now, we also know that having one whole Ethereum puts you over the average of everybody in the world. So that's something to consider if you want to be in the kind of top owners of Ethereum and being able to capitalize on the entire price movement of Ethereum throughout the year. And if you want to be a validator on the kind of staking spectrum, you need 32 Ethereum to get involved there. But honestly, even if we just want to make $100,000 or have $100,000 and Ethereum hits that $4,000 price level, you need 25 Ethereum to get there. So take that into consideration when building your Ethereum portfolio. If building that Ethereum stack sounds good, I put links in the description for Coinbase and Crypto.com where you'll get $50 in crypto just for signing up with those links. And if you want to get into meme coins here and there, I also left a link to MoonShot where you can claim some free meme coins when you sign up. If you learned something new or just enjoyed the video, make sure to hit the like button and hit subscribe if you want to stay tuned for all things crypto. Thanks for watching. I'll catch you in the next one.